In 2021, 164 American stock funds finished in the top quarter of their category, which officially made their managers the best stock pickers in the country. The managers collected their bonuses, the magazines wrote glowing profiles about their methods, and money from regular people poured in, because everyone wanted a piece of that genius. 2 years later, researchers went back and checked how many of those 164 funds were still in the top group. The answer was 0. Not a handful, not 3, not 1, 0.0%. And that number is not some freak accident, because it is the single most repeated finding in all of investing research, and almost nobody who buys stocks has ever heard of it. Quick note before we start: this is education, not financial advice, so I am not telling you what to buy or what to sell. I am going to show you what the numbers say, and today the numbers are going to insult some very expensive people. Here is the story we have all been sold. Investing is a skill game, so if you study the companies, read the annual reports, learn the charts, and spot the next big winner before everyone else does, you will get rich. And if you happen to lose money along the way, well, you simply were not good enough yet. Wall Street loves this story, and so do trading apps, finance influencers, and your cousin with the hot tip. An entire industry, managing trillions of dollars, is built on a single promise: we can pick the winners for you. And a second industry of courses, newsletters, and signal groups is built on the promise that they can teach you to do it yourself. So, let us test the promise. Not with opinions, but with the scoreboard. Every year, S&P, the company behind the S&P 500, publishes a brutal little report card that takes the professional stock pickers, the people who are paid millions to beat the market, and compares them against a plain index fund. The index fund has no manager, no genius, and no strategy at all. It buys the whole market, and then it does nothing. In 2025 alone, 79% of professional large company stock funds in America lost to that do-nothing index, which made it one of the worst years the professionals have ever recorded. But 1 year is noise, so stretch the clock out. Over 15 years, across all 22 categories that the report measures, from large companies to small companies to international stocks, not a single category had a majority of professionals beating their benchmark, 0 out of 22. And over 20 years, roughly 92% of American funds lost to the very market they were paid to beat. Sit with that for a second. These are full-time professionals with teams of analysts, expensive data terminals, private lunches with company bosses, and every advantage that you will never have in your life. In over 20 years, 9 out of 10 of them lose to a list of companies that nobody manages at all. Now, I can already hear the obvious comeback, and it sounds completely reasonable. Fine, most managers are average, so I will simply pick one of the good ones, because track records exist for a reason. Beautiful plan, with one problem: the good ones do not stay good, and that is exactly the story from the cold open. Of those 164 top funds from 2021, only 20.1% were still in the top group 1 year later, and by the second year that number had fallen to exactly 0. And when researchers followed winning funds for 5 full years, the friendliest category in the whole study, small companies, kept only about 2% of its winners on top, while every other American stock category kept none at all. Here is a cleaner way to see what is happening. Imagine you put 10,000 people in a stadium and ask every one of them to flip a coin 10 times in a row. Purely by luck, around 10 of them will flip 10 heads in a row, and those 10 will look like coin-flipping geniuses to anyone watching from the stands. The finance industry would look at those 10 and give each of them a fund, a track record, and a marketing budget. But ask them to do it again next year, and they flip exactly like everyone else, because there was never any skill in the coin. That is precisely what the data shows about star fund managers. Yesterday's brilliance predicts almost nothing about tomorrow. The sentence "past performance is no guarantee of future results" is not legal small print. It is the most honest sentence in all of finance. So the professionals cannot do it reliably, and the winners do not repeat, which leaves us with the real question: why is picking winners so absurdly, mathematically hard? A finance professor named Hendrik Bessembinder found the answer, and it is one of the most uncomfortable numbers in modern finance. He studied every American stock since 1926, more than 28,000 companies across nearly a full century, and he asked one simple question: which of these stocks actually created wealth for their owners compared with boring government cash? The result: about 4% of stocks created all of it, because every dollar the stock market has ever earned above safe government bills came from a tiny group of superstar companies, while the other 96%, added together, performed no better than cash. And it gets worse, because his updated numbers showed that 58.6% of all stocks in history destroyed wealth over their lifetime. Read that again. The average stock in history was a loser. Just 72 companies, roughly a quarter of 1% of everything ever listed, account for half of all the net wealth the American market has ever built. And when he repeated the study around the world, covering 1990 to 2020, the top 2.4% of firms produced the entire $75.7 trillion of net wealth creation. Think about what that does to stock picking. The market's return is not spread out evenly like butter on bread, waiting to be collected by anyone smart enough to show up. It hides inside a few needles buried in a haystack full of losers. When you pick a handful of stocks, you are not skimming the best of the market. You are betting that you, reading headlines on your phone during your lunch break, will find the exact needles that 90% of full-time professionals miss. And if you pick wrong, you do not get the market's average return, you get the loser's return, which across history has been roughly nothing. The index fund does not have this problem, and this is the entire reason it keeps winning. It cannot miss the needle because it owns the whole haystack, including every future superstar that nobody has discovered yet. Okay, says the trader in the comments, but I do not buy and hope, because I trade in and out every day, I take profits daily, and I have the screenshots to prove it. The data on that is even more savage. Researchers got hold of something unique. Every single trade from an entire country, Taiwan, 15 years, 3.7 billion transactions, everyday trader in the whole market, with nowhere for the losers to hide. In a typical 6-month window, more than 8 out of 10 of those day traders lost money. Fewer than 1% could beat the market consistently, and only about 3% even finished ahead of it at all. The average day trader was not just underperforming, he was paying real money day after day for the privilege of losing. And the survival numbers read like a horror film. After 1 year, only 44% were still trading. After 2 years, 24%, and after 3 years, just 15% remained. That is not an investment strategy. That is a casino with better lighting and a candlestick chart on the wall. And here is the part that stings even if you never pick a single stock in your life. Because even people who buy sensible funds manage to lose against their own funds. Morningstar compared what funds earned with what the investors inside those funds actually earned, and found a gap of 1.2 percentage points every single year, which adds up to roughly 15% of the total return gone. The reason was not the fees, and it was not bad funds, because the entire gap came from timing. People bought after prices rose and sold after prices fell again and again in the same fund across the same decade. The most dangerous person in your portfolio has always been the one holding the phone. Now, before you decide that I hate every stock picker on the planet, here comes the honest other side, because there is one and it matters. First, yes, some investors really do beat the market. A small group of professional firms with supercomputers, armies of scientists, and trading speed that no private person can buy pulls money out of the market year after year, and pretending they do not exist would be dishonest. But be honest about what their existence means for you, because every time you trade, you are sitting at the same table as them, and if you cannot tell who the slowest player at the table is, it is you. Second, buying an individual stock is not a sin. If you love a company, and if researching businesses is genuinely your hobby, then owning some shares is completely fine, and it is honestly a great way to learn how markets work from the inside. The mistake is not owning stocks. The mistake is making your retirement depend on your picks. And third, to be fair to the pickers, index funds have real critics too, and the critics have a point. Today, a handful of giant companies dominate the index, and if they stumble, the index stumbles with them. That part is true. But look closely at what the critics are actually saying, because even the index's biggest weakness is the risk of a few big stocks. Concentration is the danger they are pointing at, and stock picking is concentration done on purpose, with worse odds. So here is what you actually do with all of this in 4 steps. First, own the haystack. A broad, cheap index fund holds every needle the market will ever produce, including the winners that nobody has heard of yet. And in exchange for giving up the lottery ticket, you collect the one return that 90% of professionals fail to beat. Second, automate it. Set up a fixed amount that leaves your account every single month, automatically, no matter what the news is screaming that week. Remember the behavior gap from a minute ago. The biggest threat to your returns is your own finger on the sell button, and automation removes the finger. Third, if you love picking, build yourself a sandbox. Take 5 or 10% of your money and pick away. Enjoy it. Learn from it, but track the results honestly against the index, in writing, where you cannot argue with them. If your picks are still ahead after 5 years, congratulations, you are doing better than nearly every professional alive. Most people discover something much cheaper along the way, which is that the fun fades once it has a scoreboard. And fourth, never confuse a bull market with skill. When everything goes up, every picker feels like a genius, and every guru's course looks like it works. The scoreboard only counts after a full market cycle, crash included, so judge yourself and anyone selling you a system on decades rather than on last year. One line to take with you. Do not hunt for the needle in the haystack. Buy the whole haystack instead, and every needle inside it is automatically yours. Those 164 best funds in America had everything you will never have. The analysts, the access, the information, the private lunches. 2 years later, not a single one of them was still on top, because the game was never about picking better. The game itself is rigged against picking, and the only consistent winner is the player who refuses to play and simply owns everything. If this just saved you from your next hot stock tip, subscribe, because next time we take apart another comfortable story the money world keeps selling you. And tell me below, what is the worst stock pick you have ever made, and what did it cost you? Be honest. I read every comment.